Who doesn't love getting dividend checks, passive income? But the only problem is most of them pay every quarter at every 3 months. That's a long time to wait for your next dividend check. Wouldn't it be nice if we would get those dividends every month? Well, you're in luck. Today we're going to look at three different stocks to own that pay the monthly dividend. They're all in the real estate space. They're all REITs, REITs, which stands for Real Estate Investment Trust. Basically, it's a company that owns a whole bunch of real estate. They manage the property, so you don't have to deal with tenants, toilets, or any of that problem. And just sit back and collect your dividend check. Stay tuned for three REITs that pay monthly dividends. So here we are on the Realty Income site, the first of our three REITs that we will review for monthly passive income. So who's Realty Income? Most investors who are investing for dividend will likely have Realty Income or in their portfolio, right? So who is Realty Income? Realty Income is also known as the monthly dividend company. It's an S&P 500 company that buys real estate and it leases it back to high grade tenant. Okay, what they call triple net leasing, means Realty Income owns the property, but the tenant pays the taxes, the insurance, all the maintenance. Realty Income signs them up for these long-term leases and collects the checks. And some of that rent gets paid back to us as the shareholder or investor. Okay? And it's been paying increasing dividends for over 25 years. That's why it's a member of the S&P 500 dividend aristocrat, which means it's basically very stable. Okay, so so you kind of know a little about what they do. Let's look at some of their tenants. Okay, a lot of the tenants are going to be people like Walgreens. It's going to be a lot of companies that you know. So they have over 1,300 um, properties under long-term net lease agreement. Very diversified, over 85 different industries. Okay, and very great credit. Okay, very great credit. Let's look at some of their. Let's look at some of the portfolio. So we see that the occupancy is over 98% occupied. So they have a very tiny amount of vacancy. 98.8% occupancy. 1,300 over 1,300 clients. 85 separate industries and over 1,300 clients. And they are very diversified geographically as well. So you see in the U.S. And in Spain, Italy, they have properties. They have properties in Ireland. They have properties in Hawaii. They have properties in Puerto Rico. So very diversified. Okay, so you see here, there's 82 properties in Washington. There's 24 properties in Montana, and it represents only a tiny portion of the portfolio, 0.1%. So that's what you call very diversified. Okay, let's look at. We say there's 85 different industries. So grocery store. It said here that we provide investors with exposure to top grocery operators, as our top two UK grocery clients control approximately 43% of UK grocery market share. And our top two U.S. grocery clients control almost a third of the U.S. grocery market. So in the U.S., Walmart and Kroger represent 32%, almost a third of the grocery market share, right? And then it trails off, Costco and so on. But basically, what it lets you know is that they own likely the Walmart that you shop at, probably owned by Realty Income, okay? Dollar stores, quick service restaurants, drugstores. They own CVS and Walgreens. I mean, Realty Income is like ubiquitous. It's all over. So let's look at the numbers. Let's look at the numbers. Realty Income. So Realty Income currently is trading about $54 per share. The 52-week low is $45. The 52-week high is about $68. So it's toward the lower end, almost the middle of that 52-week range. Now, one thing let me mention. With real estate investment trusts, or REITs, they are required by law to pay out 90% of their taxable income back to shareholders. So let me add that up front. 90% of their taxable income has to be paid back to the shareholders. That's the deal they have with the government. That way, they don't have to pay taxes on the remainder, okay? But we, as the shareholders, have to pay taxes on our dividend from REITs. Another thing let me mention, the dividend that you get from REITs are not qualified. Let me repeat that again. The dividend that we get from REITs are not qualified, as opposed to a dividend you'd get from a regular corporation like McDonald's or Home Depot, which is qualified, which means it gets taxed at a much lower rate. It gets taxed at the long-term capital gain. As long as you own the stocks, as long as you own the stock for a 60-day period around the ex-dividend date, I believe it's 60 days before, anywhere to 60 days after. If you own a 60-day during that period, you're eligible for the long-term capital gains treatment, which is great. For some people, it's 0%. For most, it's about 15%. Unless you make it over like $500,000, then you pay 20%. So it's a much more advantageous tax rate. REITs are not eligible for that because their tax is ordinary income. So what most people do, or what the smart thing you could do, is to own your REIT within a Roth IRA account. If you own your REIT in a Roth IRA account, it will be tax-free because that taxes have already been paid on the Roth upfront. So let's continue. So with REITs, we don't look at the earnings. With REITs, they call it FFO, or fund from operation, which is basically the net income after all the expenses have been paid. We normally talk about the PE ratio, or price to earnings multiple, which kind of gives us an idea of how expensive something really is. We say a PE ratio below 11 or so is considered on discount or on sale. A PE ratio between 12 and 17 or so is considered fair value, and anything over 17 is considered richly valued or expensive. They don't use earnings, they use the FFO, or fund from operation. And likewise, they don't use the PE ratio, they use the ratio of the P, or price, to funds from operation, or PFFO ratio. So here you will see not a PE ratio, but a price to funds from operation ratio. Here you see the FWD, which means they're forward looking, not the previous 12 months, but the forward looking 12 months. So analysts are expecting for Realty Income to earn $4.12 per share after all the expenses. Now the price to FFO ratio is about 13, which means it's kind of like fairly valued. The dividend rate that you're going to get annually, because it's a monthly dividend payer, remember, monthly dividend payer, is $3.07 per year. Let's look at the let's look at the price appreciation of the stock over the last 10 years. Over the last 10 years, it's been lots of up and down. Mainly up. If you look at it here in 2013, price about $36. And gradually, it's a little ebbs and flows, but for the most part, the net trend is upward until 2020 March. And we all know what happened, right? The healthcare situation, big drop. It dropped from about $79 all the way down to about $42. So, and now it's been gradually returning. Okay? Gradually returning. Now let's look at our dividends. So we said it's the monthly paying dividend as all of these that we're going to look at. It pays, realty income is paying now a 5.63% dividend yield, and it will pay out about $3.07. The payout ratio would pay about 74%. So almost 3/4 of its funds from operation gets paid out in the dividend. The 5-year dividend growth rate is about 3.67%, and it's been growing its dividend for about 25 years, which is why it's a dividend aristocrat. Okay? Which is why it's a dividend aristocrat. Let's look at the dividend history. So let's look over the last 10 years. Actually, let's look at the maximum. So 1995, they're paying 7 cents per month. Then it gradually goes up. 8, 9, 10, gradually goes up. Okay. Now we're at 20. We're about 26 cents per share every month. So that's what you want to see. You want to see that gradual increase, and that's why most dividend investors own realty income, right? Most companies are paying you every 3 months, but it's nice to have a company that's paying you every month. Now the next REIT we're going to look at now is LTC, or long-term care. Long-term care is a real estate investment trust that basically operates in the healthcare space. They own and operate assisted living, nursing home, and other healthcare facilities. Okay? Long-term care. Their ticker symbol is LTC, and they pay a monthly dividend. This is the leadership. Let us look at one of their properties. It's one of their properties here. Ignite Medical Resort in Independence, Missouri. So very beautiful, right? Very beautiful property, right? We can all agree. This would be somewhere nice for an elderly person to reside if they had to go to an assisted living. Let's look at long-term care, the metrics. Look at long-term care, LTC. LTC Long-Term Care Properties Incorporated. Right now it's trading at $33.15 per share. The 52-week range is, the low end is $30.50, and the high range is $39.94. So it's on the low end. So potentially a good opportunity, a good time to pick up some shares. The FFO, again, the fund from operation, is $2.63. So that after all expenses are paid, the net income is essentially $2.63. They are paying, and that's forward looking by the analyst. The price to FFO ratio, which is equivalent to the price to earnings, is 12.6, which means it's kind of like fair value. Not bad, not a bad ratio to pick up some shares right now. The dividend rate for the year is $2.28, which is basically, if you divide it by 12, it's about 19 cents. So each month you're getting about 19 cents per share. Let's look at the appreciation of the stock price over the last. Let's look maximum. at the price appreciation. So if shares were valued at about $12.79 in 1994, so that's about what, 30 years ago, almost 30 years ago, $12.79, and kind of went down a little. But for the most part, it's been trending upwards. Again, 2020 we saw that dip. Again, it's kind of ebbs and flow. But right now, it's a great opportunity to pick up shares. Price appreciation over the last, 30 years now, we'd say, from $12 to now it's about 32. So it has not quite triple, but more than double. Okay, so the appreciation is not bad. Let's look at the dividends over this time frame. Again, it's another monthly paying REIT, so it could be great to supplement your income for your rent and your other bills. Dividend yield right now is about 6.88%. The annual payout, we said over the last, the annual payout for the annual payout forward looking is $2.28. The payout ratio is a little higher, about 86%. Oh, and let me mention this. In general, REITs, you're going to see they're going to have a much higher payout ratio because of the obligation to the government, and they have to pay out 90%, at least 90% of their taxable income back to shareholders. So you're going to see very high payout ratio. The 5-year growth rate of the dividend is about 3.71%. Not great. Dividend growth has been no dividend growth. So you have to consider that and keep that in mind. Now let's look at the dividend growth over the last 10 years. So they were paying annually in 2012 $1.91, and you go and now you look, and 10 years later it's $2.28. So the dividend growth, as we said, is not great, right? They look pretty flat, right? So again, you have to consider that as well. The price appreciation has not been that great, and the dividend yield is not that great. And this is also a smaller company too. The market cap of this company is only $1.37 billion. So it's a smaller company. Again, you have to keep that in mind. Realty Income is about a $47 billion market cap company. So the next REIT we'll look at is Stag Industrial. Stag Industrial, ticker STAG, is traded on the New York Stock Exchange. It's a real estate investment trust focused on the acquisition and operation of single-tenant industrial properties throughout the United States. Industrial properties. So keep that in mind. Realty Income was mainly retail, right? Stag Industrial, mainly industrial companies, okay? So that's what they're focused on, industrial properties. So they have over 100 leases, over 12 million square feet leased, and they've retained 72% of their tenants since their IPO. And in terms of their square footage, you can see that they have been steadily increasing their leasing activity since their IPO. Okay, that's good to see. I believe they have over 500 different properties at this point in their portfolio. Yeah, so this is the location where they have their assets. Okay, so they have them in all these places. So if we were to click, we could probably see some of them. So here we have in Sacramento, California, they have 147,000 square footage. In Indiana, Lebanon, Indiana, they have almost 600 square footage. And these are all industrial. Okay. So just for the fun of it, let's click Washington, and it'll give us the address, the market, the number of buildings, and the square footage. Oh, that's great. Okay. Now let's look at the numbers. Let's look at the numbers for Stag Industrial, which is again another monthly paying REIT. Right, it's great to get those dividend payments every month. Now let's look at the 52-week range. We see here the low of $31 and the high of $38. So Stag is toward the high end off their 52 week range. The fund from operation is $2.28, and the price to funds from operation ratio is 15.99. So fair value. Dividend rate for the year, you'll get at $1.47. Let's max out this. Let's look at the capital appreciation of Stag. So over the term, over since the inception in 2011, they're about $12 a share, and now they're about $36 a share. So over that time frame, you would have seen your money pretty much tripled. Let's look at the side of the company. The market cap is about a $6.6 billion company. Let's look at our dividends. So it's going to be paid monthly. Let's look at the dividend yield. So the dividend has not grown much. Similar to long-term care, LTC has not grown much. So that has to be considered, right? You think about, so that has to be considered. You think about inflation. And if your dividend does not keep up with inflation, that's not good. Okay? If it's dividend does not keep up with inflation, that's not good. That's why realty income, the fact that they kept growing their dividend over 25 years to become a dividend aristocrat is such a powerful metric, because it lets you know that your dividend will be keeping up with inflation, right? Here we see the dividend history. Look at this. Look at this. In 2012, look at the dividends was it was great at 21 cents, 27, 26, 30 cents a month. Then they drop it. And then it's been pretty steady, 10 cents a month. And now it's about 12. Not much growth in the dividend, as we said. So, 3 different monthly paying REITs with 3 different characteristics. Realty income seems to be the most stable. That's growing their dividend and also with capital appreciation. Long-term care and Stag, not much growth either in the dividend or in the capital. So not a financial advisor, but these are just 3 for you to consider. And until next time, MD Investor out. And until next time, I'll see you in the next one. MD Investor out. Again, I'm not a financial advisor, but we gave you 3 options to give you monthly dividends to supplement your income. But notice the difference. Realty income, dividend, and capital appreciation. So much that the dividend has been growing for 25 years that they're part of the dividend aristocrat. Long-term care and Stag, not much growth in either the dividend or the capital. So something to consider. And until next time, MD Investor, try to increase our financial IQ so we can educate ourselves, teach our children, and break the cycle of generational poverty. MD Investor out.